This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
All right. Thank you, everyone, for joining us for part 2 of this exciting podcast on raising capital and different ways that operators can get into the space of raising capital. Again, my name is Alex Perny. This is the Alternative Investing Advantage podcast. And Randy, thank you very much for agreeing to be on part 2 of this podcast. I'm really happy with how the first half went, and really excited to dive into the business structure side of things, especially for people that are new to trying to raise capital for a deal. You know, we kind of talked about, your journey of being someone that invested in single family, then realizing, hey, this is a lot of work for one door. So then can we put this through to investing in multiple doors? So for people that want to get that together and actually raise capital and be on the operational side of things, understanding not only one, like we covered in the first half of best practices, how to have those conversations, how to build your network, things to watch out for, when to say no to someone, and then, kind of, again, building that arsenal of how to go out and approach people to raise capital. Well, that's all well and good. You can have a ton of money, but if you don't have a business structure that's fleshed out to plug it into, well, that's a lot of work for nothing. So this half of it, we're really going to focus on, what type of different business structures are out there, whether you're raising capital for direct operation or fund to fund, and a lot of different things that we're going to kind of delve into. So, where do you kind of want to start with this for some high level stuff, and let's really drill down into the details.
Yeah. So first of all, thanks for having me back. The first one must have been okay. Otherwise, I guess we wouldn't be here today. It's, I think probably the best place to start is just really having a good understanding of what it is that you're trying to accomplish with the business that you're either one, creating, or two, trying to adjust to this capital raising space. So, I've talked in the past about figuring out what it is that your superpower is. And for me, being a guy that came from sales and sales leadership for 25 years, relationship building, my network, talking to investors just seemed like kind of the perfect fit for me. So when I approached this, I started looking at how do I get into this business with my superpowers, and what type of business structures should I look at in doing so. So my path is going to be very different from somebody who's bought a 4-plex and then an 8-unit, then a 10-unit, and JV'd some deals and then wanted to start raising capital for larger syndications. That's going to look different than what my path is, which is solely being somebody that helps to bring capital to multiple different operators. So really important to know, are you an operator that's trying to raise capital, or are you going to be a fund manager that's just simply trying to raise capital across potentially multiple operators, and what's really driving that decision?
Sure. So let me just kind of, again, to kind of package that for people, it's do you essentially want to be raising capital for your own deal that you are putting together and going to operate, or do you want to kind of be a little bit more nomadic with it, if you will, and that you have a skill set that you can plug into other people's deals? Because, at the end of the day, everyone needs to raise money. There's going to be different things that need to be done for different deals, but the common thread around all this is that you have to have money to buy the deal. You have to have money to take it down. You got to raise that 30% somehow to get to where you need to go. So do you want to either kind of be more focused on the single deal operational, raising it for your own, or do you want to, again, go out and be the person that raises capital for other people? Again, there's probably, benefits and downsides to both. So I'll let you kind of take it off on where you want to start with which one, and kind of go into, what might drive someone to want to do that versus the other, and the benefits associated with each.
Yeah, good question. So, again, for me, I was put into a situation when I got laid off from my W-2 in May of last year, where I knew that I wanted to jump into real estate investing full time. I had been doing it part time for a number of years, but all of a sudden I was forced with this decision: do I go out and chase another W-2 job and go find another sales role somewhere, or do I jump into this space? And if so, how do I do it? And it was presented to me that this fund-to-fund model was an option that I could leverage just to even see if my network even had an appetite for investing in these types of deals. When I first started, I didn't even know if I was going to raise $1 or if I was going to raise $10 million in that first deal. So I really had no idea. And what I find now and what I know being a year into this is that a lot of people think they can raise money until they try to raise money. And then they find out pretty quickly that it's a lot more complicated than what a lot of people think. It's not just simply as easy as getting on Instagram and saying, wire me $100,000 wires, and then it just happens. So understanding that fund to fund for me, essentially what it did is it gave me the opportunity to test this to see if it was something that would work. And then after I had the proof of concept, my business strategy and the evolution of my business grew from there. So if that answers the question.
It does, but what I'd like to kind of have you explain a little bit more is that, when you say fund to fund, what exactly does that mean? If someone were to say, okay, great, this, that sounds interesting, but when you say fund to fund, if you were to look it up in Webster's, what exactly would that mean from you as a capital raiser when you say, hey, I'm doing fund to fund capital raising?
Yeah. Well, I certainly won't say how Webster defines it, but I can share kind of a dumbed down version of it. But essentially, as a fund to fund manager, the people that are investing with me are investing into a fund that I create, which is simply a special purpose vehicle, which is going to be used to place that capital into a specific investment with an operator. So you've got ABC company that is offering multifamily Class C value add syndications. And as a fund manager, I raise capital from my network, and then we bring those dollars to that same investment that retail investors can go to. But quite often we get much better terms because we're bringing a bigger check to the table. And for doing that, my personal income is actually paid to me from the fund earnings. It's not paid to me through the operator directly.
Okay. So when you say that, are you putting together in the, fund to fund model, are you putting together a pooled investment fund for each different deals? Like saying, hey, I have this one, we're raising X amount of capital. Or are you going out and raising capital? Let's say you're trying to raise, $5 million and you plug it into operator A, B, and C in accordance with the stated investment thesis of your PPM.
Great question. And I am very specifically raising on single asset investments that are already identified, and only raising for those assets. And it's actually outlined in my PPM that these dollars will be invested in this specific asset. So the other option that you shared is a blind fund where you have an investment thesis. You say, invest in me because I've got this great track record of doing X, Y, and Z, and I'm just going to continue doing that. And, jumping into the space kind of fresh, well, yes, I was a passive investor. I didn't personally have a track record of taking people's dollars and doing anything with them for any type of track record or history. So I leveraged this SPV model that is asset specific because I then get to leverage the credibility and the track record of the operators that I'm working with. So very specifically what happens is an operator will come to me and say, Randy, we've got ABC Main Street that we are going to put in front of our investors in a couple of months. Would you like to participate in this one? And if so, how much do you think you could bring to the table? My track record tells me that I can bring anywhere from $500 to $1 million per deal on about a monthly basis is what I've been doing up to this point. So I say to them, I'm going to raise X amount of dollars, always better to underpromise and overdeliver. And then I actually get the PPM that they're going to use from their SEC attorney, and then their SEC attorney adjusts that and adds essentially my operating agreement to it, and then that becomes my PPM, which is my legal document that I share with my investors.
Okay. So just to make sure we're clear on this, because this is honestly something new to me that I haven't ever really had much exposure to. I've done a lot with pooled investment funds, evergreen funds, special purpose funds for the purpose of like a very narrow investment thesis, but not necessarily something tied directly to one operator. So
Yep.
I'm assuming that, again, you're putting together multiple different investment vehicles because it's all dependent on that one, like 123 Main Street partnership, right? It's that
Right.
one specific deal. So
Yep.
with that said, so going that direction really is going to be focused to the person that is, more focused on leveraging the is really interested in leveraging relationships. It's like, hey, I know how to build relationships. One, to raise capital, but two, I can plug in with all of these different operators and help them raise their capital. So, what would you say is kind of the benefit in your eyes from doing that? Is it mainly just kind of works into how you like to operate and what you do? Is there a better financial incentive one way versus the other? Because obviously, you're not doing this for free. There's not I don't see a red cross behind your head right there. So, how
It's
are,
not. Yeah. This case.
you got to keep, you got the lights on and the internet connection. So you obviously you're doing
Yeah.
something right. So, kind of what is kind of the impetus for someone to choose this route? What are the benefits and, maybe what are some kind of the drawbacks as well to going the fund to fund route?
Yeah. Yeah. Great question. So, um, I mean, transparently, I chose this option because it was the first option that was presented to me when I started in this space. And the partner who I initially had partnered with was an operator that I personally had invested with very, very heavily. And I had also referred a ton of money to him from just my network because I was excited about what I was doing and I shared it with my network. So when the opportunity presented itself, it really was kind of a no-lose situation for me to see if this capital raising space was really going to be something that I could make a business of and potentially make a few dollars doing it. So initially, I chose it for that main reason, and I got to partner with one of what I think is one of the best operators in the entire country in the asset class that I favor. So it was really kind of a win-win for everybody involved. So some of the good and the bad of it, though, is, from a good standpoint, it does give me the ability, once I get a track record of raising some dollars, where that is something in this marketplace specifically that is very, very attractive to other operators. So you become kind of a commodity and something that is sought after if you can prove that you can raise $500 to $1 million a month, because operators out there are having a hard time raising capital. Okay. So there's not a lot of risk to them because I either bring the money or I don't. And there's just upside for pretty much everybody involved. They're essentially leveraging my network without having any business risk by bringing me on board. Okay. So the benefit to them is that there's really no downside. Benefit to me is it gives me the ability to really kind of create my own brand, create my own lead gen, create my own business around providing this diversification to my investors. And then my core value that I end up bringing to my investors is my due diligence efforts that I put into it, my vetting of operators that I do, the selection of the deals that I participate in, those types of things that I'm bringing to my investors. So there's a lot of benefits there because I'm not tied to any one operator. And it gives me the ability. I could even be raising on 3 or 4 or 5 deals a month if I had the ability to raise the capital. Whereas if I tie myself to one operator, they might only do 1 or 2 deals a year, and then what am I doing the rest of the time, right?
Sure.
So
Yeah, absolutely. Yeah, deal flow is definitely something I see as being a big advantage to this because, but again, deal flow is contingent on the fact that you having the network. This isn't something where you say, "Oh, this is great. I'm just going to plug in." You have to have built a network, or at least have, if you're talking to someone cold, a very good track record. Of being able to do this for them to even want to plug in to what you have going on. Now, one thing that kind of popped into my mind is that, we got into a little bit on the best practices, but making sure, again, if you're trying to raise capital, that you are, going in accordance with whatever, regulation under the Jobs Act that the security is being offered under. Do you kind of steer towards, because I'm assuming that when you marry up your fund to theirs, it has to be the same kind of solicitation standard. It either has to be Reg D, Reg A, like you have to kind of be in conjunction with it so they don't, kind of have opposing viewpoints. Do you find that you like to plug into one versus the other, or do they kind of both have their benefits and drawbacks? Maybe you could speak to that a little bit.
yeah, absolutely. So, and this is a great question and something that I've spent a lot of time thinking about over the last year or so. My first two operators that I worked with were 506B operators. So it was strictly friends and family, direct network, pre-existing and substantive relationship. I reached a point where I wanted to have the ability to be able to start marketing at the broader level. So my third partner that I started working with only worked with accredited investors and had a 506C fund. So yes, the operators you partner with do dictate what type of offering you can provide, and you have to obviously honor that. And you're limited to whatever decision that they make. So yes, absolutely, that's important to consider. And a lot of people, or the mindset that I had was, I had this thought that once I started advertising a 506C opportunity, I thought my business would explode at that point. Now, it didn't. It did uptick a little bit because there is some value, I think, in having multiple operators and multiple asset classes that actually does. It increases your overall capital raising results because you just have more options, and I don't know if it's a credibility thing or whatever that is, but there's some statistic that Neil Bawa shared from the stage where he suggested you would increase your capital raising results by 70% by bringing another asset class into your offering or offerings. I didn't quite see 70%, but I did see an uptick. But it is important to have a strategy there and understand what it is. Just because you go over to 506C doesn't mean you're going to start raising a ton of money, because there's a lot more competition in the 506C area.
Yeah, and just to be clear, 506C does mean that you can accept unaccredited investors, and but you can openly solicit. Which one is the?
You can openly solicit, but they have to be accredited investors.
They have to be accredited. Yeah, that's it. It's I deal a lot in this stuff, but some of the finer points get a little bit hazy. So
sure.
Yeah. Now, again, so do you kind of, again, do you follow that thesis with all of your offerings now of just only wanting to partner with the 506Cs, or do you kind of, again, if one looks really good, you might kind of go back over? Is it something where you feel like you need to be fluid, or you should really focus on being competent with a track record in one avenue or the other?
Yeah, great question. So I am not, it's kind of interesting. I spent the first, call it 8 months, raising only for multifamily. And I'm very much a multifamily investor myself. 65% of my investments are in multifamily personally. But then I got this short-term rental 506C fund, and that's what I started advertising. And all of a sudden, I started getting branded as a short-term rental guy, when really I'm a multifamily guy. So, I'm looking now at trying to find an operator I can work with that's a 506C, so I can advertise, the multifamily space, or multifamily deals. But I'm not going to let that trump whether an operator is a good operator to partner with or not. So I think at the end of the day, if you put good deals in front of your investor network, over the long run, that's going to pay better than any type of business strategy that you might be using to try to manipulate that in some way.
Yeah, and I think it also kind of organically goes into, do you try to be wear a few different hats with regards to, the different investment avenues that you expose your clients to? Obviously, you said, that you're a big fan of commercial multifamily, but you did get into a deal that put it in front of investors that was based in short-term rentals. Is it something where you feel like having a very well-defined and narrow investment strategy is key? Or again, you can diversify only a certain amount when you're saying, hey, like, we're going to get with this operator because they're buying in this location versus that location. And yeah, you can have diversity within an asset class, but to really have true diversity, you need to have, again, some things that gets outside of that. So, commercial multifamily, short-term rentals, maybe something like light commercial with car washes or self-storage, or maybe getting into heavy industrial, to have that really wide diversity. Do you feel like that spreads you too thin, maybe, if you're kind of the single-man operation? Or, is it good to have, a narrow scope, or just, really be hyper-focused on that one asset class, but diversification across locations?
Yeah, so I think as an operator, it's extremely important to be very niche-y and be very specific in what it is that you're doing. I get concerned when I see operators that are doing, development and value add and mixed use and self-storage and, any people that are just chasing any opportunity that they can. Like the goal with my personal investment dollars is to place those dollars with people that are experts at what they do, and they're very single-minded, single purpose. They are very boring. It's just basically singles and doubles, cookie cutter, same thing over and over and over again. That's where I want to place my dollars. But as a capital raiser, my superpower, if you will, is simply introducing deals to investors. And for me, it became important after having 800 conversations with investors over the last year or so that I have other types of options available for my investors. So, Class C multifamily is not a good cash flow opportunity for investors that are looking for cash flow. So very specifically, I chose short-term rentals because it's a much better cash flow opportunity, and it gave me an option of I've got this option or nothing else. Now I've got this option or this option, and it gives them the option of investing in two different things, or investing with me or not investing with me. So as a capital raiser, I think it's less important to have a single investment thesis compared to the operator itself.
Yeah, and I think what it would also be fair to say is that, from your standpoint, it's important to be able to bring, diversification not only in, what the actual end play is, whether it's cash flow, whether it's capital appreciation, be able to have a well-rounded kind of, deck, if you will, of things saying, hey, here's what I can bring you when I have a deal. You're not just going to get the same exact thing. There's going to be options for you. If you need cash flow, if you need something that has a long-term, loss structure where you're going to be able to get good tax benefit from it, there's going to be a large diversification, and you can do that because, again, you're beholden to making sure that the end operator is a consummate expert. So you're going to that person saying, hey, this person only does heavy industrial. They have a great track record. I'm bringing this deal because of X. You don't have to be necessarily the subject matter in that, because you're making sure that you are doing the due diligence on the operator, the deal to an extent, but you're not getting someone that, it's their first industrial deal and all they did was, C-class value add multifamily in a different location than that's being operated in, which I think is interesting in the fact that it gives you a lot of flexibility operating, again, in the fund-to-fund space. Anything you want to maybe add to that?
No, I think you hit the nail on the head. Definitely. It provides you with flexibility and allows you really tailor the investment offerings to different types of avatars that you might have a focus on.
And, obviously we've kind of focused a lot on the benefits of it, but I would imagine, just like with anything, if it was that great, every single person would do it because it's not hard. But there definitely is difficulty in doing this. One, raising the capital is difficult, but two, kind of what would you say are some other difficulties that kind of go into doing something like this? I would imagine deal flow is probably, one of the things that is hard, because you're having to go out and do the due diligence on different operators on different deals. And especially with the market going the way it kind of is right now with, cap rate compression, the velocity of money, and also just how expensive money is getting, the deals have started to kind of narrow down. So what are some of the difficulties in going this route before we start looking at the single operator capital raise structure?
Yeah. And actually, oddly enough, deal flow is one of the benefits of this, because if you do a good job selecting operators that have solid deal flow, then that obviously translates to your ability to put those deals in front of your investors. So, I was fortunate that I partnered with two different operators that are very large multifamily operators, and they have maintained pretty consistent deal flow over the last number of years that I've been working with them. So that has not been an issue. Now, some of the challenges that come up, especially if you start working with multiple operators, if you're leveraging your own systems, or if you're leveraging their systems to manage communications and distributions and such, like, your dependence on them for all of those resources can be a hindrance at times. So if that operator drops the ball and doesn't send a communication, then that reflects badly on you. So Same is true as if you're working with multiple operators and you're leveraging their systems for portals. Then your investors have 3, 4, 5 different portal logins with different platforms that they have to get comfortable with and use just to work with you and have access to all of your deals. So something that we've done recently is we have our own portal now. We're using InvestNext, which is, some of the biggest players in the space are using InvestNext, and I can present all of my opportunities through my portal. And then I can handle distributions, I can handle communications, I can handle K1s. Everything is handled through me versus having 3 or 4 or 5 different communications coming to my investors for all the different things that are required there. So that's probably the biggest one. Let's see here. There can be delays in a fund-to-fund model. Ultimately, what happens is distributions are paid to the fund, and then the fund has to turn around and send those distributions to their investors. So if people want to get their distributions the same day they're sent from the manager, from the target operator, then that's not likely going to happen. There's going to be a couple day lag there. And the same is true with communications and K1s as well. We're always waiting for the operator to get us the information before we can give it to our investors.
Gotcha. Now, it brings up kind of an interesting point of, if you're going to do this, what are maybe some red flags to look out for? You could have someone that, again, at the end of the day, the investor, coming from the investor standpoint, I want to see track record, I want to see experience, I want to see, past performance. Obviously, covering past performance does not dictate future returns.
Of course.
But, I want to see all that. And the systems that they have are really not something me as like a kind of a retail investor, retail's a bad word, but just a normal limited partner would deal with. If they have kind of a crummy CRM, if my check's clear and they're communicative, I don't really care.
Sure.
But from your standpoint, you want to make sure that hey, you could have this really polished thing, but if there's, bad communication with them and everything else like that, that all reflects through you. So if you're plugging in with these people, they could be great guys, they could pay on time, they could have great returns, but what is kind of that scale? Like, what are some things that you would say if you're going to go fund to fund that you should really be leery of, or is it something where you don't know until you don't know, which obviously is maybe kind of one of the risks of going this route, is that you don't have as much of a viewpoint of their systems beforehand as you would if you were raising for an individual fund. So maybe speak a few points on red flags on things that people should watch out for if they're going the fund to fund model.
Yeah, great question. So when I first got started, at least when I initially was getting into the space, my thought was that as an investor who's been now in 24 different LP positions across 10 different operators and 6 different asset classes, part of what I was presenting to my investors was that I was only going to put deals in front of my investors of operators that I had personally worked with before and had good positive experience, appreciated the investor communications and the distributions, all of that information. And ideally that sounds perfect to be able to offer that, but it does limit your ability to put new operators in front of your investors, because of the 6 that I have or of the 10 that I've invested with, there's probably only 6 of them that I would be comfortable putting those deals in front of my investors today. And if I truly wanted to grow this business and make it a sustainable business that could allow me to earn the dollars to reinvest back into the business to make sure that it's sustainable for my investors, I needed to grow this quicker than that would have allowed me to do. So I had some learnings along the way where I needed to get comfortable, and this was something that was challenged to me by my coach was, if the vetting you've done and the research and all of the effort you've put into making sure that an investment is good enough for you to put your dollars into it, why is it not good enough to put it in front of your investors as well? It really challenged me to make sure, one, that I am doing the vetting that I should be doing on every single operator. And then 2, if I am, then I should trust that and be able to put it in front of my investors. And I've started to do that. I invest alongside with my investors on those new operator deals, but I'm not going to limit it just to those, because what I'm finding is as I've spent more and more time in this space, I my education in this space has been, like hockey stick up to the right. The amount of knowledge that I've learned just in the last 6 months is probably 10x what I've learned in the last 5 years in this space, just simply because this is what I'm doing, like more than I used to be working when I was working full time. That's one. And I'm trying to remember what the question is, but I think that was one area
Yeah,
to
it
answer
was
that.
based
Yeah.
on red flags to look at, and I think what I'm kind of taking away from what you said is that don't let perfection stand in the path of progress. Is that if you may be, and this is going to be different from everyone else, but if you're the person that says, hey, I want this to be as good, there's no such thing as a perfect 10, but I want to be hitting a 9.9 with what my investors see from me. The
Yep.
CRM, the portals all look super nice and clean and polished. But if I go out to an operator and I'm looking at it and, just because it's not up to, my exact standard of how they have everything, but the deal looks good, they're going to be good stewards of the capital, they have, excellent track records, everything else like that. If I feel comfortable to invest in it, just because it doesn't live up to my super high expectation of what my, clients see from my back end, granted, there's a level, if they're sending
Sure.
out
Yep.
if they're sending out handwritten notes, okay, maybe not. But again,
Right.
just because it doesn't live up to the exacting standards you have for yourself, if you feel comfortable putting your capital with them, let that be a lesson that you should, maybe open yourself up to a little bit wider, variety of it. Again, perfection and progress need to, be a little bit divergent in that scenario.
Yep. Yeah. And I would also say too, it's important early on, I was afraid to spend money on the business, out of a scarcity mindset. And I wasn't quite sure if, I didn't want to go spend a ton of money on systems and building process and all of that if this wasn't going to be a successful business. But what I know today is that the dollars I spent early on were almost wasted dollars because I should have got the systems early on instead of getting the band-aids and then replacing the band-aids and replacing the band-aids for the ultimate solution. So, spend the money on getting a good CRM because the CRM that you use effectively is invaluable, and make sure that you're comfortable with branding and email marketing, and spend some money on a podcast if you want to. You've got to find a way to share the message. So you've got to invest in this space, in any business for it to be successful. And I think a lot of people come into the space and they hear these stories about get rich quick in real estate and no money down and it doesn't cost anything, but that is very few and far between with the people that I've seen that are actually doing big things. So understand it's going to take hard work and effort, and you're not going to see results for a while, and you have to invest in the business or the business is never going to grow.
Yeah, there's a reason they call them get rich quick schemes. They are schemes at the end of the day.
Yep.
And exactly, and I would also point out is that if you're going to go this model route, is that everything is so, when it comes to anything with regard to finance or anything in life in general, it's so, from the system standpoint of how you plug in, since we don't, go to the bank teller and talk to, the people face to face, the systems are so critically important because that's what's going to be the handshake you have with someone. It's not, you show up to a business meeting and you got coffee stains on your shirt and, your buttons are undone, your hair's frazzled. That's the first impression you wanted to avoid. Why not carry that same thing over to the first impression you have with your client, which is going to be digital? In some form or fashion, they're going to log on and it's going to be, digital in some. So have that digital handshake, if you will, be as good as it can be. Granted, spending $100,000 to make $20,000 when you're first starting off in business, maybe not the best case, but there's a happy medium, just like anything in life. Now, I think, again, we covered your expertise on the avenue that you went, but that's not the only avenue to go when going into the capital raising space. We covered the fund to fund, which I find really interesting because I haven't really talked to someone in that avenue, but it makes complete sense of having kind of that special purpose fund that plugs in and leverages the expertise and the value that a single operator has without having to, go the pooled investment fund route where you have just a melting pot of stuff, being able to focus on the specifics of that and give your clients diversity through individual operators, I think is really interesting. But that's, again, not the only avenue to run with if you want to get into the capital raising space. So let's kind of, let's shift gears a little bit for the second half of this and look at what the other options are for people that want to get into capital raising and commercial real estate.
Yeah. So fund to fund is what we were talking about, but there's another option, and there's probably many other options as well. Those are just the two that I'm familiar with my, call it 15 months experience in the space. There is a co-GP option as well that I would say a smaller number of operators are open to doing, because there are some legal issues that can arise in compliance and SEC requirements that come into play, just like in anything. So always consult your attorney to make sure you're going down the right path and make sure you understand your risks. But as a general rule, when you look at a general partnership, they take a look at ownerships of that general partnership based on the activities that you're doing in the overall business. And you'll see kind of the split on that a number of different ways, but quite often capital will get 30 or 35% of it. So you could get 35% ownership in the GP if you bring all the capital to a deal. Asset management will generally be another area. And then, acquisition, disposition, are kind of the three main categories. So with that being said, there's this 35% of the GP which goes to capital, and it's really, really important to note, and I'm not an attorney or a CPA, so certainly check with the experts, but there is an option where you can get a portion of that GP by being involved with bringing capital to it, so long as you also have material involvement in the operations of the business as well. So if it's agreed upon on the front end that you're going to get 10% of the GP to bring capital and handle asset management, then you can get 10% of that GP by doing those activities for the operations of that entity. So there is a lot of people that's what they do. They form their GP team with kind of the expertise being aligned in those three categories. And you can have multiple people involved with any one of those categories as well. So I've been fortunate enough to partner with one operator and soon to partner with a second, where I'm going to be doing also the co-GP business model, where I'll be responsible for asset management duties as well as bringing capital to the table. And then I basically have a seat at the table. I have voting rights. I influence the business model and the business execution, and some would argue more credibility in the space because I'm more involved in the business.
Yeah, so I guess that would probably be one of the, the activity that you're doing is basically going to be the same no matter what you do. If you're trying to raise capital, you're trying to bring dollars in the door. At the end of the day, if what you're doing, you're bringing dollars in the door for it. But the big difference, I would say, again, there's many differences, but the big difference between one of the two is that you get to have a much more active role in the management of that asset, whereas what you give up on the fund to fund is that you're reliant solely on what they're doing, and that there's a large amount of trust that's built in, saying, hey, I trust them to do the right thing, because if I feel like they're not, well, at the end of the day, I'm just plugged in as a limited partner. I don't have the ability to steer that ship much afterwards. There might be some ways you might be able to influence it, but voting rights, there's a lack of that. Now, being a co-GP, again, you're going to be a little bit more narrow mindset. You're marrying yourself to a single operator, if you will, to raise capital for that, but you're also potentially going to be more involved in the upside of a particular deal. Would that be accurate? Or what would you say are some of the big benefits to that besides just having the voting rights that would be associated with being a co-GP?
Yeah, and I think it's all dependent upon the operators that you're working with and the situation of the deal as well. So I don't know that you can give a blanket answer to that, but my experience is that the economic benefit is about the same, regardless, based on my experience in the last year or so. But yes, the big benefit is that I get to be more involved with the asset management. And, the goal at some point for me is to take my capital raising efforts into the acquisition and management of assets on my own with my own team to get a bigger and bigger portion of the general partnership. So, when I first came in as an LP, I wanted to get a peek behind the curtains on syndication. As a capital raiser, I've gotten a further peek on it. in the fund-to-fund model, and then as a co-GP, I'm getting an even broader look behind the curtain. So I think it really just comes back to looking at what it is that you as a business owner, as a strategist, are trying to achieve, and then leverage the tools, i.e. business models and structures that are available to help you meet those needs. Yeah.
Now, would
reach
you
those
say
goals.
that one type of person would be better suited? Like if you are maybe good at the, raising of the capital, but maybe not as good on the networking aspect, or you're not as analytical. I mean, I know it's a hard question to answer because it really depends. It's your mileage may vary.
Yeah.
What you may
Sure.
think is one thing, but again, to give people kind of, again, this is, a peek behind the curtains without being directly involved in that, is that, there's obviously two different routes because there's, benefits and drawbacks to both, and one's going to be better suited to someone versus another.
Yep.
But if you were talking to someone, again, just off the street that said, hey, I really wanted to get into the multifamily space, I think the capital raising side of it is good for me. Obviously we've covered two options here. What would you say, if you were going to ask them a few questions, say like, hey, I think you would be good at this because you're good at this, versus I think you're going to be good at this because you're good at this. What would be kind of a steering the ship answer to that?
Yeah. I mean, you've got numbers guys that are involved, with acquisition, analysis, underwriting. You've got project managers that are your asset managers, and then you've got sales or extroverts, whatever it is, people that are comfortable having those conversations. Those are really kind of the three profiles or avatars that are generally involved in a GP. And of course, they bleed over. Some number guys might love project management. Some sales guys might love project management, or maybe sales guys and number guys, maybe not so many. But there's a pendulum for sure. And like any partnership, it's important to have people who kind of fill the gaps of the others. So always looking for a team that meets all of those type of requirements is really important to finding a successful team. So
Gotcha. So I would maybe even say what I kind of took away from this: if you enjoy being, beholden to no one but yourself, the model that you employ, the fund to fund, really works well. If you like being that very, very entrepreneurial, like self-employed mindset, I feel like that really works well to that. If you're more of a systems person, then being plugged in with a single GP where you have voting rights to change things you don't like and be in tighter control really works well for you. But, on the front end, you're giving up the ability of diversification, being plugged in because, your time is your most valuable asset. If you're plugged in with the operational side, the voting side, setting everything up, running, and at the end of the day, it is a business. Being a GP is, an active business that you have to be involved in. It limits you from being able to step back like you do and plug in with this person because they're doing the back end. You're analyzing it, making sure you have that trust. Okay, we're raising capital, plugging in there. Rinse, wash, repeat here, here, and here. So again, I think that, at least from what I'm taking away, is kind of the big benefits, one versus another. You have to figure out what plays well to your strengths and what you feel is going to make you the most comfortable, because if you're not comfortable doing what you're doing, you're not going to be able to raise capital. You're not going to be a good steward of other people's capital. And, at the end of the day, it's not going to be a good fit. With that kind of bringing us towards the end of this, what are some kind of closing thoughts you would have on business structures that you feel like, if we missed anything, or if you make sure you really want to have people take away from this two-part series on choosing the right avenue or avenues in general?
yeah, thank you. We've covered a lot of ground over the last two different two podcasts that we've done here. And I think, the beautiful thing about real estate is that, one, it's very forgiving, but two, like, if you just start and you make the decision to move forward with it, you can readjust very quickly, just like I did as well. So if you're coming into the space and you have a general idea what it is you want to do, then start pursuing activities down that path, and you can very quickly change into other paths as well. Just like myself, just because I started as a capital raiser doesn't mean that that's where I'm going to finish in 10 or 20 years, but it's certainly going to add value to my tool belt as I continue down this path. So, more important than anything, it is just to start. So if you're interested in getting into the space, jump in, I'm a believer of the jumping out of the plane and building the parachute on the way down. If you wait till you have all of the information before you make your decision, you're never going to get started, and you're just going to be sitting there on the sidelines, just like I did for 5 years before I started investing in real estate. So take action, jump in, adjust, and you can't go wrong in this space.
Yeah, a marathon is started with one step. So
absolutely, and finished with one step. Yeah,
exactly. Just it's the 26.2 miles in between that.
In between, yeah.
But anyways, thank you so much. I really appreciate your time today, taking time out of your busy day to do a 2-part series with us. Covering everything from the best practices of raising capital, and then if you're going to raise capital, what are some different avenues you have for structuring your business, whether you're doing fund to fund, marrying yourself to a GP, and being more involved in the operations. I think it was one of the more interesting and insightful podcasts that we've done. Breaking it up into 2 parts like this was definitely beneficial. So Randy, if people want to get in touch with you and learn more about what you have to your offerings that you have, or get more involved with what you have going on, how can they find you?
Yeah, of course. Website is probably the best, impactequity.net. If you need an immediate response, reach out to me on LinkedIn. I am always on LinkedIn, but those are the two best sources to find me.
All right, fantastic. Well, again, thank you everyone for joining with us today. It's been a great 2-part series. My name is Alex Perny, and as always, thank you for joining us on this edition of the Alternative Investing Advantage podcast. Have a great day.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.